Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra and you're watching MF Corner. Today we are going to talk about two important categories of mutual fund investing. One is the balanced advantage funds and the second is target maturity funds. Does the present scenario that indicate an interest rate cut make the balanced advantage fund more favorable? Also, what about target maturity funds? There's been a debt tax change which has come about. Does it still remain a good bet? We have a lot to discuss and we do have two guests who are joining to us in the studio today. On that note, let's welcome Niranjan Avasthi, who is the SVP and Head Product Marketing and Digital at Edelweiss Mutual Fund, and Sahil Kapoor, Senior EVP at 360 One Wealth. Gentlemen, thank you so much for joining us here, and to have an in-person conversation only makes it better. Let's start first up with the balanced advantage funds category. Do you think, let me start with you, Niranjan, first. Considering that this year could be a year of interest rate cuts, how do you look at this particular category? Is this time ripe to be looking here?
Right. So, markets have been, volatile all in all over the last 10 decades, if you see. Across the world and even in India, last 10, 15 years, 20 years, whatever history we have, markets have been volatile. This year, thankfully we have seen 2023 being a very good year, but as we come closer to elections and many other events, markets would be volatile. While economy is on a strong footing, but you cannot negate these kind of events and volatility which they can create. And especially when the valuations are on a higher side, even a small news can create lot of jerks in the market. Markets tend to become more sensitive to these news. In this kind of situation, balanced advantage funds can be a savior because it tends to reduce volatility from your returns and give you a smooth journey, and you don't know which way the markets would go, whether it will go up or down. Balanced advantage funds beautifully adjust to the market conditions and are a good choice for investors who want to take a little bit of lesser risk, at the same time keep investing or keep participating in equity markets.
They're named as such, right? Balanced
Absolutely.
advantage funds.
Yes.
So it advantages you
Yes.
by being very balanced. Sahil, your take on this particular category, and what do you say would be some of the advantages of investing here?
So I go what Niranjan is saying. Typically, if you look at historically, the drawdowns for balanced advantage fund are much lower than of an equity fund and of a regular hybrid fund, right? So obviously, it's at this valuation level, it makes sense to enter these funds. Also, these funds do well with the markets, choppy, right? If the market's trending one way, these funds will underperform an equity fund or they underperform even a aggressive hybrid fund. So in a choppy market, which typically happens at higher valuation level, these funds obviously make much more sense. The biggest advantage, I would say, two big advantages. A, if you look at all the funds, they have a very disciplined approach to investing. They rebalance equity and debt allocation in a very disciplined manner, using valuation metrics or some momentum metrics or some sentiment metrics. So very well disciplined run funds, and all the churn is actually tax free for you as an investor. So if you do this on your own outside, obviously you pay short-term capital gain tax, but all the churn happening is tax efficient for you, which is a big advantage of the BAF category.
And who doesn't like tax efficiency when it comes
absolutely.
to investments? That is one of the things everyone grapples with. So your take, Niranjan, what do you think would be some of the advantages you would mention when you invest in a category like this?
So there are three distinct advantages. One is asset allocation. Basically, people tend to forget about asset allocation, especially in markets like this when it's going one way. It's a disciplined way to do asset allocation. It's a model-driven strategy, and there are no emotions which takes into account how much you should allocate to equity and debt. So it's a model-driven, much more disciplined way. The second is tax advantage, as he mentioned. The important point to note is these funds manage equity level between 30 to 80%. And even when the equity level is 30 or 40%, at times when markets are falling, the taxation of these funds is equity. So now imagine which kind of product would give you 30-40% equity with equity taxation. This is the category which gives you, because it hedges the portion, and gross level is always above 65%. Where
I was just going to ask you that. What happens when it goes
so basically, it happens so because on a gross level, the equity level is always about 65, 70, 80%. But these funds tend to reduce equity level by hedging through maybe arbitrage positions or futures, shorting the futures. And that is how you have equity taxation with lesser amount of equity levels. The result is lower volatility, lower drawdowns, model-driven approach to investing, and disciplined asset allocation.
Then I just hope no one's listening to that. You know, what if they come up with some tax changes there as well? But makes sense, right? That if you're getting the advantage of equity taxation with lower equity in your portfolio. Sahil, when should one not look at this category? We spoke about volatility being one of them. Is it a long-term
I mentioned
investment?
two things, right? A, if the markets are upward trending or downward trending, these will obviously underperform the aggressive hybrid funds or the equity funds. Secondly, some investors want to have control of their own asset allocations, right? So I think they probably avoid this category, or they invest a small part of the equity portion in this category only because they want to have their own control on the asset allocation. That's the two things. But I think that because the manager itself is churning the portfolio, right, basis market, basis the market environment, the investor should stay put. He should not obviously go and churn himself. That would be disadvantages for him. So it needs to obviously be a long-term investment in your portfolio. If you don't have the wherewithal or the bandwidth to change asset allocation yourself, I think it's a great investment to have in your portfolio. It's a static investment, not churning it regularly.
So it is a long-term investment, should be there in everyone's portfolio?
Absolutely. I would, like to give another point of view. Actually, this fund is for everyone. An aggressive investor tend to go overboard on equity, and they are overweight on equity always because they are bullish. But this kind of product actually reduces some bit of risk in their portfolio. So this could be a satellite part of their portfolio for aggressive investors. At the same time, conservative investor, this is the go-to strategy because low level of volatility with equity participation, it's amongst the best option for them. So it's both for aggressive as well as investor. Who is it not for? It is basically investors who want to beat equity markets on an absolute basis. They want to generate higher returns than market. It is not for them. And typically, so core and satellite for all investors, but if you're looking to beat the market, it's not for you because these products are not designed to beat the market on an absolute basis. On a risk adjusted basis, they are beautiful products.
Okay, all right. So take that point. But is there enough interest coming in from retailers in this category? Sahil, you go first. Are you seeing that retail investors are coming to you and say, okay, we would look at this asset class or this mutual fund category and invest there?
Yes, of course. I think it was designed for retail investors. Investors who are typically investing into FDs are now moving into this category because they have low drawdowns, much higher risk-adjusted returns. So retail investors are definitely participating in this category. The category has positive flows, since it's been launched. I think even HNIs or family offices are now looking at this category because post change in the debt taxation, people are coming into hybrid products, right? Obviously, they're preferring hybrid products with higher debt and lower equity allocation. But even BAF is an emerging category among HNIs and family offices.
Okay, and your take here, Niranjan, it's not been very old. It's not. It's fairly a newer category.
So I've seen this category very closely. One of the oldest fund I've worked on it. At Edelweiss, this is our largest fund. Also one of the oldest fund, Edelweiss Balanced Advantage Fund. If you look at the numbers, within hybrid set, this is the largest category in terms of AUM, over 2.5 lakh crore. In terms of folios, almost 45 lakh folios are sitting in this category, and this is just a 5-year-old category with 31 funds. The oldest category in hybrid funds, hybrid category is aggressive hybrid, the erstwhile balanced fund. They have just around 50 lakh folios, 53 lakh folios. The AUM is around 2 lakh crore. So in 5 years, this category has grown very, very large within the hybrid set. So I think so a lot of interest from retail investors, from, as you mentioned, from HNI investors. This category is actually a blue ocean category.
Blue ocean, you hear that term not very often nowadays because it's all Red Sea now. Everyone's going everywhere in investing. But then in that case, Niranjan, what has the typical return been on this particular category?
Right. So there are two parts to it. When you look at absolute returns, on a 10-year basis, the category returns are roughly around 10-11%. When you compare this with maybe Nifty 50, because it's a broader market indices, market returns are around 14%. But the good part is, over the last 10 years, the volatility, that is standard deviation of Nifty, is around 16.5%. Volatility for this category is around 9.5-10%. So with 60% volatility, that of the index or markets, you get almost 70-80% participation. That's broadly one number. The second is on a rolling return basis. So I don't have the category numbers, but If you look at our own Edelweiss Balanced Advantage Fund, which is one of the oldest in the category, on a 3-year rolling return basis, almost 87% of the time it has given returns above 7%. Average return is around 10.5%. On a 5-year rolling return basis, again the average is around 10 to 11%, and almost more than 90% of the time it has given more than 7% return. And most important thing, on a 3-year basis and a 5-year basis, the returns have never been negative.
Okay. And
that is an important point to note when you are coming in this category. So drawdowns are lower, average returns are between 10 to 11%. So if someone is looking for a fixed income plus kind of return, this is a category to be.
No wonder banks are talking about lower deposit rates, right? Everyone's moving to these hybrid products. Gentlemen, it's been a very interesting chat, but we have to slip into a quick commercial break. When we come back, we'll talk about target maturity funds, especially post the debt taxation changes, how are managers looking at this particular category. So stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Niranjan, Avasthi and Sahil Kapoor. We spoke about balanced advantage funds, and now, gentlemen, we'll talk about target maturity funds. So let's start with that. And Sahil, let me come to you. Explain for the benefit of our viewers what are target maturity funds and who is this beneficial for?
Target maturity funds are the best replacement for an FD, right? So unlike other mutual funds which are open-ended, these funds have a fixed maturity date. So if your investment horizon is same as the maturity of the target maturity fund, your returns are very predictable, as well as an FD, right? The other advantage obviously are being liquidity. It's a well-diversified portfolio compared to just buying a single issuer. Next, obviously, as I mentioned, you have liquidity, and also you have cost advantages. They are passively managed funds, so no active fund manager risk, low on cost. And the biggest, difference, I see is of tax deferment, right? Although tax has changed, but tax deferment is huge. So if you go buy a bond by yourself, whenever you receive a coupon, you pay tax. That part doesn't get reinvested back into the fund, right? Out here, you don't pay tax when your coupon is received. You only pay tax right at the end. So that deferment itself, adds 25 bips to your yield, right? So that's the big advantage of mutual funds. Obviously, they're well diversified, which also kind of helps a lot. But FD investors, fixed income investors can obviously look at this category. The flows have been very, very low post the tax change, but people should not forget debt. Lots of benefit of conventional debt, which cannot, you cannot replace it through equity or any other kind of asset class. So yeah.
No, it makes sense that debt is what will bring diversification to your portfolio. So that was going to be my next question. Niranjan, has the debt taxation changed things in this category? We are seeing lower flows, but is interest coming back here?
Definitely, debt taxation has been kind of headwind for this category, because we have seen after that the flows have muted actually. But I think so it is only about time when people realize that the benefit of this category is not just taxation, because fortunately we are talking about two categories which we like, which I personally like very much, and TMF is very close to us, because at Edelweiss we started Bharat Bond, and that was the first TMF that we launched. When we designed this product, it was not only for tax, honestly. The real reason was a lot of people invest in fixed deposits today, and the best feature of that is visibility of returns. And we wanted to give that feature in this product. I think so it is only about time that people realize, apart from tax, there are multiple benefits in this category. One is, liquidity, instant T+1 liquidity, which not only this, but debt mutual fund offers. No other instrument offers such good liquidity instantly. That allows you to do asset allocation. You can't swing your asset allocation using FDs and bonds so easily. So that is one reason. Second is deferment of taxation. It's a big advantage. Over 10 years, if you're not withdrawing any money, why to pay taxes on it? Let that tax part compound, and over a longer period of time, that could actually mean a difference of between 15 to 20 basis points over a longer period of time. So these are two biggest advantage, I would say. Third advantage is, only this is the category where you can actually look to make more returns when interest rates are falling.
Correct.
So you can take that advantage, and in today's scenario where we believe that there is a potential rate cut, I think so this category adds a lot of value.
No, I was just going to ask you, do you think
Yes.
correct macros right now to go ahead and look in this particular category? So what would returns look like here, Sahil? Typical returns on target maturity funds. And now that we are talking about a possibility of a rate cut, do you think from the previous levels you would see a higher number?
So as I mentioned, if you're an FD investor and your investment horizon is same as the maturity of the fund, I think you will range from 7.5% to 8% is what you can make on target maturity funds. But you know, as Niranjan mentioned, if you want to play the rate cuts, you can obviously buy a longer maturity fund than your investment horizon, and then you can probably add 2-3% more if the rates drop by, say 100 basis points from here, right? So obviously, it's how you play the category. You can play it as an FD investor, hold to maturity, predictability of returns, or you can also play it for the rate cuts, right? So you can play it either which ways.
Okay, so it will be a long-term asset class in your portfolio.
See, one advantage now is that because there is no 3-year taxation law, you can even play it tactically.
Yeah.
So you know, it can also be a 6-month investment for you. So how you play it is important, right? You can either play it for tax cuts, or you can rate cuts, or you can play it for, you know, as a simple hold to maturity investment also.
So that's why experts like you come in, right? If somebody doesn't understand whether it has to be tactical or long term, you can guide them there. What has the return on Bharat bond been like, and how does it compare with other funds in this category?
So if you look at the current opportunity, because that rear view investing doesn't work, because what you will be earning is around the YTM and plus whatever capital appreciation. So today, if you look, like 2025 Bharat bond ETF, the yields, the YTM of the portfolio is upwards of around 7.8, because the liquidity is tight on the shorter end, the opportunity is very good. And you asked that question, Sonal, that whether it is for long term or short term, the beauty of target maturity fund is if you want to invest for 6 months or 1 year, there is a product for it. If you want to invest for 10 years, 15 years, there is a product for it. You just need to match your investment horizon with the tenure of target maturity funds for strategic investments, and you can just choose. So, you know, as he mentioned, the long term, like 2037 target maturity fund is yielding around 7.5, 7.6. So you can choose the bucket. At the same time, tactically, if someone wants to invest for 1 or 2 years, they can go for a longer term target maturity fund, and what you can earn is the YTM, which is 7.5, plus maybe 1 or 2%, depending on how much interest rate drop we see over the next 1 to 2 years. So there is that additional benefit. So you can choose. These products are so beautiful that you can select the objective you want and play it accordingly.
And that's amazing. But you know, the thing is, debt instruments in general are so complex that people are like, how do we invest in? What do we invest in? There are such long duration or short duration funds. But as I said, that is where experts like you come in, and you can help people demystify the world of debt funds. But gentlemen, it's been such a pleasure speaking to the two of you to understand these two categories. Slightly complex, as I said, but you made it easier. So thanks a lot for joining us today. And with that, we'll take your leave on this edition of MF Corner today. But stay tuned for Closing Bell to take you through the last hour of trade.
Presented by